Thanks very much, everybody. Thank you for being back. My fault for us not being back on time, but we will be on time for lunch. So we'll give you some rapid, good, solid information. And with no more of ado, I will hand over to Troels here from Aberdeen Investments. And Troels is just gonna run through some of the kind of key trends, key numbers here that they're seeing across their portfolio in terms of Aberdeen Investments in the logistics side and industrial side. And then we can use that to pick up in the chat afterwards. And as ever, very interested to get your views on that. We have Kilian joining us as well. And I'll also pick up with Esther. And if anybody met Esther already in the networking, you will have already done that. But I'll pick up, because Christiana is not here, I'm interested to hear what you're hearing, Esther, as well, about your discussions with the institutional investment side and what their perspectives are on this area. But for now, we can welcome Troels. Troels, thank you.
Thank you, Richard. And well, thanks for giving us at Aberdeen Investments the opportunity to present our outlook on the European industrial and logistics sector here from, well, 2026 and beyond. No doubt that we are currently seeing a huge transformation across Europe, and we expect this to continue. So we see this as a structural change and not necessarily a cyclical change, but I'll come on to that later on. This is a brand new presentation done by our, well, I shouldn't take any credit for this, since this is done by our in-house research team at Aberdeen Investments. I hope the most of you will be aware of Aberdeen Investments, despite not having the same presence here in the Nordic region as we used to have. But Aberdeen is very research and macro research led, and we have the advantage of having a dedicated team looking at well, macro economics, as well as doing deep dives into different asset classes: equities, fixed income, real estate, infrastructure, etc. I promised Richard that we will do this punchy and high level before we move on to the fireside session together with Kilian. The presentation I have brought here today covers, first of all, a bit of the usual corporate marketing. So I'll just give you a brief introduction to Aberdeen globally, as well as our European footprint. High-level market overview over the industrial and logistics sector, sector trends, and then I'll move on to some performance drivers that we think will have a crucial impact on this investment segment in the years to come, as well as our outlook for performance over the coming well, medium to longer term. And hopefully I'll be able to draw some high-level conclusions at the very end of this presentation. As some of you might already have, well, discovered, I'm Danish. My name is Troels Andersen. I'm based here in Copenhagen. I've been with Aberdeen for nearly 15 years. I have been working within the real estate investment industry for around 18 years. And prior to that, I spent around 10 years working with real estate lending across Denmark, Germany, and the UK. And my focus for the last, well, many years has been European. So me being located here in Copenhagen is more a coincidence than it's a strategic decision of Aberdeen. Let's just put it that way. I have overall responsibilities for all our commercial real estate funds in Europe, and we have a number of those. And alongside with that, I am the lead fund manager for a pan-European logistics fund that's listed on the London Stock Exchange, having had exposure in Germany, France, Spain, Netherlands, as well as in Poland. So we're pretty well covered across Europe. Aberdeen, I'll try to keep it short and high level. We are among the top 10 real estate managers in Europe. Within logistics and industrial, we are actually the second largest manager across Europe, taking into account the UK as well. We are a top 10 manager when it comes to living and residential, not only in Europe, but actually also having a broader global reach. We have, due to, well, historic reasons, we have a strong presence in Asia Pacific as well. And we are headquartered in London, where we are listed on the London Stock Exchange. We manage in total around 40 billion euros of assets within real estate, so it's a fairly chunky business. The focus is very much on the UK and Europe, as you will see here at the pie chart to the right. Approximately 50% of our exposure is in the UK, and around 35% is across Europe. We have high conviction in two segments, one being living, so very interesting to hear the panel session this morning. And then we also have a high conviction within logistics. And on that note, I would like to stress the fact that those two segments have actually been, the highest ranking segments within our house view for nearly 15 years. We have dedicated teams working within both living as well as logistics. So this is very much our focus. Not saying that we don't see pockets of interesting investment opportunities across retail and office, because we certainly do that as well. But the main focus is very much on logistics and living. We have 13 offices globally with real estate investment specialists. We are invested currently in 20 countries. It's mainly Europe and the UK, but as I also mentioned, also in APAC. We manage more than 800 assets globally, and for the last 5 years we have seen a fairly large annual transaction activity of nearly 4 billion euros annually over the last years. Leaving aside last year, because no doubt that 2025 was a bit muted in terms of transaction activity. But in the recent years, we have seen fairly chunky numbers in terms of transaction activities. Doing a deeper dive into our exposure within the industrial and logistics segment, we manage around 18 billion euros of industrial and logistic assets, mainly UK and Europe. That corresponds to more than 350 assets. We invested in 12 countries in those two segments. And Aberdeen as a business has been focusing on these segments for more than 40 years. So it's highly integrated in our investment process. And we are highly convinced about these segments, and I'll come on to that later on, but no doubt that we are seeing a massive transformation across Europe currently because of, geopolitical noise and the need for more resilience. So why should investors, in our opinion, why should investors consider investing into industrial and logistics? Well, first of all, this is a huge investment universe. Again, these are estimates and rough numbers, but nearly 90 billion euros of assets within this segment. That's a lot of money without any doubt. Investor sentiment has changed over recent years. I think it's fair to say that historically within real estate there was a strong focus on retail, traditional retail, as well as more traditional office buildings. That has very much shifted, in our opinion, to living as well as industrial and logistics. And this transformation is something that we still believe, in terms of industrial at least, something we believe is still at the early days in terms of this structural transformation. But more about that later. In terms of performance, on an annual basis, on average, these segments have delivered around 8.5% total return, of course consisting of an income return, but also capital growth over the last 20 years, according to our own figures, but also supported by figures we have from Savills. looking ahead, and of course that's always very difficult to predict about the future, but based on our house view, we sort of expect a similar performance over the coming 5 to 7 years, EI meaning in the range of around 8 to 9% total return. Those return expectations and estimates, they are at asset level and not taking into account any kind of leverage. So in our opinion, fairly attractive returns, also in an environment where that interest rates have come back down again to lower levels. Very strong supply and demand fundamentals, in our opinion, and that's just something that we expect to improve even more. So we see some very strong fundamental tailwinds when it comes to market fundamentals. We also like this asset class because we believe that there will be very attractive value creation opportunities. We are seeing a transformation in terms of ESG. We are seeing these tailwinds in terms of supply and demand. And in most countries, we are also seeing a sort of degree of reluctance when it comes to new developments in greenfield areas. So we think if you're in the right location, even with, an aged portfolio, there will be some attractive value creation opportunities where that you'll be able to attract very solid tenants and also be able to increase rental income, passing rental income in your assets. I have touched on the performance characteristics, both historically but also in terms of our expectations looking ahead. These segments, industrial and logistics, they despite putting them into those two buckets, in our opinion, they consist of a wide range of property types. I'll come back to that later on, but this is not only traditional logistics, EI, a big box, somewhere in a fairly remote location, but this is everything from R&D facilities to urban last mile logistics, but I'll cover that later on in the presentation. Within Aberdeen, we have identified these 6 value chains where that we believe there will be a massive transformation over the coming years. No need for me to read it out, and I'm sure that the presentation will be circulated to all of you afterwards. But just to pick out a couple of these, I think security and defense and tech, it goes without saying that we are seeing some significant structural changes in terms of defense spending, in terms of a need for Europe to stand on its own feet. We cannot rely on the US as we have used to do. And in terms of resilience, for example, COVID was an eye-opener, I think, for many businesses. Now I'm not talking real estate as such, but our occupiers, our businesses, our tenants. We saw examples where that car manufacturers were waiting for a chip to be received before they were able to, say, finalize car keys to be able to actually deliver those complete cars to consumers, etc. So that there is a need for resilience, there is a need for nearshoring, and we think this is just going to become even more in the years ahead with all the changes that we are seeing more or less on a daily basis. Energy and power, same goes for that. Basically, we have all been aware of the need for Russian gas. I think it's fair to say that there is a strong focus within Europe, as well as coming from the US, that we need to build up our own energy supply chain. So a lot of transformation, a lot of change within Europe as a general. Of course, that has an a significant impact on both industrial and what we consider being more traditional, supply chain in terms of logistics, etc. So building resilience is simply necessary for Europe, since we need to be able to stand more on our own feet. And I think it's also fair to challenge the fact that we have now been through a period of approximately, say, 75 years, where globalization has been, top of mind. And now we are actually entering into, in our opinion, a new period, a new era, where that we are looking more at deglobalization. Again, these transformations, these changes within the value chain that we had identified, we think that that is very, very supportive for real estate. And of course, that's of our interest. And as I mentioned earlier on, we think this impact will have a positive effect on the entire real estate value chain, from everything from R&D facilities, where that we have basically, for a number of years, in Europe we have outsourced our production to China, and in terms of innovation and tech, that has very much been outsourced to the US. I think it's pretty clear to everyone that that needs to change now, and we are seeing some really strong political drivers in terms of making that change here in the coming years. So again, in terms of real estate, impact on R&D facilities, traditional light industrial to more classic production and assembly assets, down to classic big box logistics, and at the end of the day, the last asset class in this segment, at least, being last mile distribution in very, very urban locations. And I think just going back a few years, what we saw during the pandemic was that in particularly that last mile distribution segment saw a massive boom. There is simply a need now for these kind of assets, and we are all becoming more and more demanding in terms of delivery time. So if we order something on the internet, we expect it to be with the consumer at least within 1 day. So location is key here. And what has also been key, actually, and not to underestimate, is the fact that for businesses, it's very important to be able to attract the right people. And if you have locations far out, basically on a greenfield location somewhere, it has proven to be difficult to get people to commute to these locations. And in terms of costs, of course, the rental levels in urban locations, they tend to be higher than for, say, these ones, for the more classic big box logistics. But in terms of overall cost levels, it's actually not important for businesses. It's important for us as real estate investors. But in terms of the occupiers, of the businesses, it's much more costly to be located far away and having to transport your goods to the center of London or to the center of Frankfurt or Madrid or Copenhagen, etc. So being close to your end consumer has actually a massive cost advantage for these businesses, which we think will be able to drive up rental levels in the right locations. Moving on. As I also mentioned, we're seeing a structural shift in policy, in EU policy, and I'm not going to read out loud all these examples, but just bringing this to life. For example, we are all aware of solar panels being installed across many assets. Right now, we are seeing that around 95% of all solar panels installed within the EU, they're actually produced in China. and now it has been mandated that by 2030, EI, only a few years out, at least 40% of all new solar panels installed in the EU from then on will have to be produced within the EU. So that policy change and that policy driver will have, in our opinion, a very strong effect on the need for high quality and modern production and logistic facilities in Europe. Also touching on the defense spending, which is for sure a big theme currently. Savills have estimated that over the next approximately 5 to 7 years, there is a need for around 37 million square meters of new industrial and logistic assets related only to the increase in GDP spending and the target of 3.5%. I know it's not that easy, but just doing a fairly simple back of the envelope calculation, taking 37 million of square meters and using, say, an average production or logistics asset of around 25,000 square meter on average, that will require approximately 1,500 of modern and newly built industrial and logistic assets across Europe, only related to the increase in defense spending. So again, in our opinion, some really strong fundamental drivers in terms of supply and demand going forward. You'll have heard me now using the word and expression structural change, structural shifts, a couple of times, but it's fair to say that here in the recent year, we are also starting to see, in our opinion, a trend which will support a more cyclical change. The change in EU policy, the need for new production assets, etc., we think that is now the start of a cyclical change, where that we will start to see businesses spending more money, investing more money, which will again then require a number of new and modern assets across Europe. I should say the heat map here to the right is a heat map that has been produced by our colleagues within the Aberdeen research team. And the reason for me pointing this out is that I know that they are very proud of this. We have been tracking investment opportunities within this region for many years. And what we see is that there is a very clear concentration in certain locations across Europe, where that we think that that there is an even higher degree of strong supply and demand drivers supporting locations in these regions. Also in terms of nearshoring, or with the situation around Ukraine and the conflict with Russia, we're also starting to see, and China as well, we're also starting to see nearshoring being phrased as friendshoring. So the resilience on China we have seen for many years, that's shifting. And here from the period 2019 up to, mid last year, you can see that the change here is going from 6 to 15%. 15% is of course currently still not a massive number, but the change over a fairly short period of time has been significant, and we continue this. We expect this to continue in the years to come. I briefly touched on performance. Here we'll have a bit more detail over historic performance, as well as return performance outlook. The figures you see to the left on this chart, these divides between core industrial and logistic total return forecasts at asset level, and again taking into account this is at asset level. So if you move on and you take on, and you are able to take on a certain amount of leverage, and of course deduct transaction costs, taxes, fees, etc., that, in our opinion, will actually allow you to achieve some mid-teen double-digit returns on 5-year forecasts if you invest within these segments. Coming to an end before the session with Kilian, we believe, as I've said, that we're currently seeing some significant structural changes. There is a need for Europe to stand on its own feet. We think that's very, very supportive for both logistics and industrial assets across Europe. There's quite a bit of catching up to do, and I think it's also fair to say that the majority of assets, at least within the industrial segment, some of them tend to be a bit outdated, and from an investment point of view, for years it has been questionable if investors would make money on investing into these assets, because rental levels were kind of fairly stable. Now we expect that that's going to change, because we think being in the right location, being in a modern and high quality asset, can actually lead to investors achieving higher passing rents. So we think suddenly it will be possible to invest in also old stock assets and thereby achieve attractive returns going forward. Again, just some of the sectors that, in our opinion, are underpinned by these powerful thematic and structural trends. Security and defense, economic growth. I heard what was said about Germany, but I also completely agree with Richard that in terms of investor sentiment, we are starting to see a shift. There is a strong focus on the UK and Europe. It's top of mind. There is a lot of capital out there which has been sitting on the sideline for a couple of years. I think we are all getting more and more used to the geopolitical noise. I think, during 2025, we all got a bit confused and scared when there were some news coming from the White House. I think that's now simply becoming not normal, but we're getting used to it. And there is a need, due to increasing pension investments, etc. There is a need to deploy that capital in the years to come. And we think now is about the right time to seriously consider deploying into these segments, alongside with resi and pockets of office and retail, of course, as well. So there is a need to modernize and overhaul supply chains. Deglobalization is most likely not going to go away overnight. And I think it's fair also to say that things, they will stabilize at some point. But we have been used to having, we've been used to buying goods produced in China, and we have been used to having the US as the safeguard. I think it's fair to challenge that has now changed over the last couple of years. So there are some needs. And finally, just touching on also on the ESG discussion that was part of the first session, we actually also believe that the whole transition and focus on energy will create opportunities in terms of investing into ESG-related activities. But we also completely agree with what was said, that it's not necessarily top of mind. It's not something that's being highly marketed in terms of ESG requirements. It's simply just becoming a tick-the-box exercise. It has to be there. And for many investors, for a number of years, it has been difficult to, in our opinion, to generate really positive returns investing into ESG-related matters, whereby we think that's now changing. Again, coming back to the comment about solar panels, having to 40% of all newly installed solar panels in the European region will have to be produced in Europe. We think there will be kind of a, let's call it snowball effect, but we think that sentiment is changing.
Thank you, Troels, for the good presentation. I can fully support what you said. So I have a similar feeling of the market. Let me briefly introduce myself and Periskop. I work in the industrial sector since more than 20 years. I started as a PhD student and research assistant in 2003. During that time, institutional investors primarily invested in office, retail, residential. So I thought, what's with logistics? And I identified that it's possible to increase the risk-return ratio or improve the risk-return ratio when adding industrial properties to a portfolio with residential, retail and office buildings. Afterwards, I did real estate transactions for 5 years, and after the financial crisis, I decided to launch the first logistics fund in Germany, and several other funds followed. I worked at Triuva, Patrizia, and I started to work for Periskop in 2021. There I'm responsible for the business unit logistics and light industrial. Periskop has 70 employees in Germany. We have a strong focus on the German market. So we are not a European-wide investor, so we have a clear focus with the business unit logistics on Germany and that property type. So what we offer, especially for international investors, to do sourcing, due diligence, acquisition processes, asset management, and also investor relations and selling assets in Germany.
Great, super. And Esther?
Yeah, my name is Esther. I'm very happy to be here. I'm heading the international capital raising at Periskop Partners. So as Kilian has mentioned, we are a Germany-based and focused on Germany a real estate investment manager. We are looking at several strategies. Logistics is one of them. I'm very excited to be here, and we are aiming to be the partner of choice basically for international money to come into Germany. So we have a large German investor base, but we also have money from Asia and Middle East, and I'm working to get some money also out of Europe.
Great, and also thank you for stepping in, because I asked Esther about 10 minutes into the break whether maybe she could share something. So good, thank you for doing that. Let's pick up, Kilian, just with reactions, I suppose, to the presentation, what your take on that is, how you're seeing that playing out in the German market as well.
Yes. So when we launched our first fund in 2012, I would say the market was comparable to the current market environment. Especially when we are looking at the price level. So when we started our first acquisition for logistics, we paid multipliers of around 15 to 16 back in 2012. Then yields the multipliers increased to a multiplier of 30 and even above. And what we see in the current market environment is that prices decreased significantly, and then we are back to a pricing level of 5 to 6%, so a multiplier of 17 to 20, so that there's upside potential again within the market. And that's for brand new assets. We see in the German market assets for multiplier of, let's say, 17 in B locations and a multiplier of 20 in A locations. So that's really a very attractive pricing. And also when you look at costs of plots, building costs, there is a moderate margin for the developers. And that changed due to, let's say, 2020, 2021, when prices were up a lot.
Okay, good. And just in terms of, there was obviously a mention as well from Troels in terms of some of these strategic shifts, nearshoring, those elements. How is that influencing the market in Germany? Are you seeing those, that changing actually happening in terms of your portfolio?
So we had very strong reshoring and nearshoring effects during the pandemic. In 2021, 2022, there was no vacancy within the market because the occupiers rented everything which was available during that time. Then the vacancy rates increased in 2024, 2025. Now developers stopped doing spec development, so we only see BTS developments at the moment. So vacancy rates are going down again, and as Troels described, there will be significant demand in the next 5 years from the defense sector. As you presented, more than 6 million square meters are needed only in Germany for the defense sector. Then we have food e-commerce. Companies like Picnic from the Netherlands, they have very strong growth, and also other grocery stores offer food e-commerce, so that's also a growing sector. Then we see growth of Asian companies coming to the German market. They are looking especially for more space in North Rhine-Westphalia, because many stuff is coming to the harbors in the Netherlands and also to Hamburg harbor. So many goods are coming to Rotterdam, and then they are transported to North Rhine-Westphalia, and they are doing the distribution from North Rhine-Westphalia within the German market or also within the European market. I think it's fully right what you described. The effect of the occupier grows within the next 5 years. So and also when you speak to letting brokers, they're calling us during the last 2 or 3 months on a regular basis and asking, do you have space available? Our portfolio is 100% let, so we don't have any vacancy within the portfolio. But as there's no spec development in the current market environment, probably we will see increasing rents. What I like on the logistics sector is you don't have to invest a lot of capex. So when you have an office building, you have a new tenant, then you have to do a refurbishment. You have to invest 500 to 1,000 euros per square meter for a new tenant. When you get a new tenant in a logistics shed, you usually have to invest only very small amounts of money. So you have a very stable cash flow. And I think that's important, especially for pension funds, to have that stable cash on cash yield. That's what logistics offers. So I see a lot, as Troels described, very interesting investment opportunities, especially during the next 5 years.
Okay, it'd be interesting to pick up, Esther, from you, and then also Troels, given your role where you're looking, you mentioned that you're looking across both, all of the sectors in terms of the funds, but it was interesting to see the split there where you've got a large chunk of living and logistics. But Esther, how is it perceived by the institutional capital? I mean, Kilian there mentioned about, solid cash flows, but what are you seeing? Are there differences in terms of the approaches between, let's say, the German institutional capital, the Nordic institutional capital, Dutch capital, UK capital?
Well, I think just to take a step back, just a very broad picture, I speak a lot of the Nordics pension funds and also to Benelux pension funds and also to the global aggregators that have their offices in London. And they look at the map and as you mentioned before, Richard, and also you, Troels, we live in times of a lot of geopolitical uncertainties and people are just looking for stability. And where do they get stability? They are looking where interest rates are stable. So from a global allocation point of view, I spoke with a lot of the global allocators, and they view Europe in general as a very safe haven now, because the inflation is stable and the interest rates seem to be stable, and they shy away more from the US, for example, because there's a lot of pressure on the inflation, which is already high, but then they have their imported inflation and their tariff inflation, and so people are looking for stability, yeah. And a lot of money will be allocated into Europe, and we've both been at the INREF Investor Intentions Roadshow in London. I think 11 out of 15 of the preferred global targets where people want to invest their money, 11 out of 15 are in Europe. UK is number 1, Germany is number 2. I'm very happy about that. So people are looking for stability, long-term stable cash flows, and now this comes back to logistics is a perfect sector for that.
Let's pick that up briefly as well, Troels. I mean, do you think, I mean, there are two schools of thought, I think, one of which is that, okay, well, geopolitics, Trump 2.0, it's already a year in, there's only another 3, or, you know, you can let it run out. Is it worth changing all of your supply chains, doing all of this if you think it's going to change? Or the other one is that this is just an indication of where we are and better to make that change and start making that change now because it's a long-term change. What's your sense on that? Do you think people are changing for the long term in terms of supply chains? Is that what the nearshoring indicates?
Well, definitely the latter. As I hopefully also alluded to in the presentation, we definitely do believe that this is a structural change, and well, even with Trump, well, most likely only having 3 years left in the White House, we don't expect this necessarily to change. We need to be more resilient across Europe, both in terms of production, defense spending, nearshoring, etc. So, and all the geopolitical uncertainty and noise we have all experienced here recently, I think it's fair to say that looking at the US, it's no longer as predictable as it used to be. And investors, they like to be able to predict when they invest their money. So I think it's, yeah, we definitely believe that a lot of global investors will be looking more at Europe, and it's definitely not to the benefit of the US. And we even believe that potentially Canadian investors and investors from APAC will be more laser focused on Europe.
Okay, yeah, go ahead.
Speak to occupiers, they told us they changed from just in time to just in case. So they want to make sure that their production can work and that not specific parts are missing, and they would like to deliver their goods to the clients. So the mindset of occupiers changed. They see uncertainty in the world, so the Ukraine war, tariffs in the US, and several topics, the pandemic in the past, and so they want to make sure that the supply chains work. So that's the reason why they do nearshoring and reshoring.
And what, I mean, I saw the heat map was interesting to see, particularly around Germany as well. Interesting to see that, and Benelux, Netherlands especially. I suppose, are you seeing that also? Does that reflect what you're seeing in Germany, or is the heat map around, you know, because it's based around bigger centres, that maybe this is not where we're going to see more demand from things like defence? So I suppose, what are we seeing in terms of the location of some of these these logistics sites?
What I can say about the German market is we see strong demand in the western region. So Hamburg, because of the port in Hamburg. Then we see North Rhine-Westphalia with Cologne, Düsseldorf as an important market. Then the Frankfurt area, the Rhine-Main area, Stuttgart, Munich. These are the let's say hotspots within Germany. There are also some locations in the center of Germany, like Kassel, Bad Hersfeld. That's an important location for national distribution because you can reach every location in Germany in 3 to 4 hours by truck. What is a bit difficult at the moment is the eastern region in Germany. So, for example, when you look at Leipzig, there are lots of sites available, lots of development potential. So, our preference is to invest in the western part, especially the western part of Germany. In the eastern part, there are also some interesting locations. For example, Dresden. There are a lot of companies. They are looking for space. There's nearly no vacancy in the Dresden area, but Leipzig, Halle, even Berlin, there you have a bit more vacancy. You have not so many producing companies. So we would prefer to invest in the western region and center of Germany, for example. And so that's a normal logistics business. And what we then see is demand from the defense sector. So they are looking for space not very close to big cities. So they are looking to locations close to infrastructure, close to motorways. And what I think is very interesting when investing in the defense sector is you have very long lease contracts, often 20 years. You have excellent creditworthiness. You have, for example, the German army or companies belonging to the state are other tenants. And you have nearly no correlation with other businesses or industries. So from a portfolio management perspective, it's part of logistics, but you don't have the correlation to other industries. So perhaps I wouldn't say it's an own asset class, but or property type, but you have less correlation with other assets.
And Troels, just coming to you, it was very clearly an industrial and logistics, but we focus quite a lot on the logistics side of it. But obviously, along with the defence logistics element, if you're going to have more homegrown research and development, manufacturing facilities, that's also going to require more broader industrial as well as part of that strategy.
Definitely, yes. And taking one step back, I think historically, I think it's fair to say that logistics was probably sitting within the industrial segment then and was kind of a niche back in the years. But given the growth in e-commerce, the pandemic, etc., suddenly it became an investment universe on its own. I think in terms of industrials, we're going to see kind of the same trend going forward. Because again, going back to the presentation and what has been said here, we simply need to build resilience, and Europe needs to be able to stand on its own feet, and also in terms of hopefully the war in Ukraine coming to an end in near future. That, in our opinion, will also lead to a need for more investments, because there will be huge demand to build up that entire region. Once hopefully the war does come to an end.
And is that something that's on the minds of institutional capital, a pause in terms of Europe, or at least let's say Central and Eastern Europe, Esther, because of what's happening, the war in Ukraine, and a solution to that is then likely to bring that capital back into the wider region as well? How much of that is a block, do you think, for institutional capital?
Well, I mean, institutional capital look very interested at everything that has happened in Germany over the past half year. We have a new government. There was a big fiscal package that was brought on the way, and investors are asking, okay, where's this fiscal package most likely going? And it's going into logistics, right? I think we will see the most impact there, as you said. A lot of square meters are missing in the defense sector, and also if you look at Germany from a geopolitical, a geographical point of view, we are in the heart of Europe, and it's also an important. We are an important strategic partner for NATO. So I think investors expect a lot of impact on the German logistics sector from the fiscal package. Yeah.
And we've had a move, obviously, as well, from logistics being something which was viewed as a service element, if you like, to industrial, to manufacturing, to then e-commerce driving huge growth. But we've now got it being positioned as something which is necessary for security of countries. So it's becoming critical infrastructure, which means we're seeing a difference in terms of, from the real FDI side, a lot of desire from a foreign direct investment position for people to talk about what's happening in their ports, in their airports, in those elements, and wanting to attract logistics as a part of that story. So a huge change there. How much of a driver do you think that is? And again, from your perspective, is that something that is picked up on by institutional capital to say, okay, well, actually, this means this isn't a 1 year, 2 year, 5 year fund play. This is something that is going to be for the next 10, 20, 30, 40 years.
Well, I think it's quite interesting. I attended a conference half a year ago. Also, there was a logistic panel, and there was a question from the audience. asking about defense logistics. And the lady who moderated the panel, she was from a church pension fund, and she was of course like, no, we can't do that. And then she passed around the question in the panel, and everybody was like, oh, our ESG requirements, and they don't allow it. But if you talk to people about these opportunities now, I mean, we have an opportunity in the southern part of Germany, where the German army will rent a very big space for all their clothing, and so people are starting to look at these types of opportunities, because, as you said, security is a very important good, and it's now more or less critical infrastructure, and I think there's a lot of change in how people think about it. Yeah.
Okay.
Completely agree, but actually taking one step back, I think it's also important to stress the fact that it's not all only related to, say, fiscal spending, defense spending, etc. Because actually where it really took off was during the pandemic, where it became clear that there was a need for highly modern and well-located logistic assets due to e-commerce, and that's definitely here to stay. And comparing with the US and the UK, believe it or not, we are still by far not at the same e-commerce penetration level as in those regions. So we believe that there is still growth potential due to, well, call it now normal e-commerce growth.
Yeah, it's been interesting to see, because e-commerce obviously shot up during the pandemic and then obviously leveled off, and everybody was going, oh, well, that's the end of the e-commerce boom then. But actually, of course, it then went back to what it would have been before. And so the growth is still going up, which I think is interesting. And let's very quickly look at just big box versus last mile. Where are we seeing the demand for that, I suppose, from the tenants and also the investment side?
Both is needed. So, I mean, e-commerce companies, they want to minimize truck traffic. So they are looking for last mile assets close to bigger cities. But also there's still quite high demand for big box logistics outside the cities, and then we have the defense demand, and I think for the defense demand, there we have a time frame of around 5 years. So there's a fiscal package and there's the budget which should be invested during the next 5 years. So these assets have to be built. I think it's an advantage, because most of the assets will be brand new. So you have energy efficient assets. But when the infrastructure is there, then I think there's no more significant growth. So within the next 5 years, new assets come to the market for the defense sector, and then a level is reached, and the space is there. For e-commerce, it's something different. I'm sure that for a longer period we will see growth. For example, Asian companies are coming to the European market. So far we have Zalando, Amazon, but we will see more companies coming to the European market, and they also need space for their business. Then we see the pharma sector, for example, and there's a need to store specific medicine within Europe. So we saw that not every medicine was available during every time. So there's a need to store more medicine within Europe. When you look at the automotive sector, the growth is limited there, but you also need space to produce more electric cars, for example, and you also need storage capacity for batteries. You have for fire safety reason you need specific properties, so we need more properties to store batteries for cars. Today, in Germany, most of the cars, I think that's different in Denmark, but in Germany, most of the cars are still usual cars and not electric cars. So we will need more storage capacity, especially for batteries. And I think that sector will also grow. So it depends on the sector. I think cold storage is also important, because when we see a growth in food e-commerce, more cold storage facilities are needed. And the cold storage facilities we have today are often quite old. And especially from an ESG perspective, it's very important to have modern infrastructure or energy efficient infrastructure within a cold storage facility. So there's more demand. Then we see more digitalization. Old assets will disappear from the market because they cannot be used anymore from the occupiers. So they need modern energy efficient assets. And I think what is very positive within the German market is that it's quite difficult to get building permits for logistics. So when you would like to get a building permit in the Munich area, in the Stuttgart area, a greenfield development is nearly impossible in the meantime. When you look at Poland, for example, during the last years, it was quite easy to get building permits and to develop assets. So for standing assets, it's a big advantage if it's more difficult to get a building permit, because the value stays quite high. When you are in a country where you get easy building permits, you can see that in the Netherlands, when you look at the office buildings around the motorways, PwC, KPMG, they moved every 10 years to a new office building. And the reason for that was it was very easy to get new building permits. And when you look in Poland at logistics assets, it's the same effect. So the developers get quite easy building permits, and then the tenants move to the next asset. And as it's quite difficult in Germany to get building permits on greenfield for new developments, that's good for standing assets, that they keep their value.
And specifically, and we'll do very short answers on these so that we've got time for the lunch part. Do we see, therefore, we're talking about restricted, very little speculative development, restrictions in terms of zoning of land. So does that mean ultimately that rents are going to go up? And is there a ceiling on this? How long do we expect that to happen? When do we expect it to happen?
Well, do we expect rents to go up? Definitely yes. How high? I wish I knew, but definitely in, say, foreseeable future. That's definitely our take.
Yeah. So I mean, nearly all rental contracts are indexed. So there you have an increase of around 2% every year. And also the market rents, they increased quite a lot during pandemic. So there we saw rent increases of 10, even 15% during pandemic. Then the last 2 years, rents were quite stable. But as we see the quite high demand, or expect high demand during the next 5 years, we also expect at least 2% rent increase during the next 5 years. So and when you look at the return figures, you have around, for new development, 5 to 6% cash on cash yield, and then you have the rent increase every year by 2%. And when you sell the asset, let's say in 10 years time, you can easily achieve 8%. So I fully agree with the figures Troels showed on his slide. So we expect for core assets at least 8% IRR target. And if you invest in older stock, which you can buy for cheaper prices, you can even achieve higher returns.
And how do we see things like, outdoor industrial storage, those kinds of elements, big in the US, being talked about a lot here, but is that forever a niche sector, or is that a potential growth sector? Are there things that we should be looking at, really?
It depends on the location. Close to harbors, you have quite high demand for outdoor storage. It isn't such a big market as it is in the US, but there's always demand. So if you have a property on a big plot, that's always an add-on to find a tenant for outdoor storage. So that's always an opportunity to increase the returns, and that's also what we do when we have assets on big plots. But it's not business like in the US.
Okay, good. And just to pick up, I suppose, on the locations element of it, you showed the heat map in terms of demand. Where are you suggesting that people should be looking in terms of locations? You can be Europe. Yeah, let's start with you, Europe, and we'll pick up on Germany as well.
Yeah, no, I was actually going to say Germany. Germany has been through a tough period of time, without any doubt. But we think the future for Germany is looking fairly bright. So in terms of industrial facilities related to defense, etc., and the history with German production, cars, etc. We think Germany will benefit from that. In terms of more, say, traditional logistics, without any doubt, locations close to large harbors in the Netherlands, Rotterdam, etc., in Germany, Hamburg, there will be very interesting growth opportunities in those regions too. And then looking at Eastern Europe, we think Eastern Europe will benefit from the fact that it can offer cheaper labor force. And the same actually goes for some parts of Southern Europe, where that we think within Aberdeen that, for instance, Spain has some attractive characteristics in terms of cheaper labor force and people who are used to work hard. Actually, so.
Okay, good. Dominic.
Yeah, when you look at
Kilian, sorry, I was on the previous panel. Dominic, yeah. Dominic's, he's going to say living though, isn't he? So.
Now, when you look at the trade routes in Europe, I'm convinced the Netherlands is a very good location within Europe for logistics, but also Germany. Most of the trade routes are going through Germany. So, as I mentioned, Hamburg is an excellent location, and Rhine-Ruhr area, Rhine-Main area, and also the southern part of Germany, Stuttgart, Munich. We not only need more storage capacity for the defense sector, there will also be more industrial production within that sector. So companies like Rheinmetall, they would like to increase their production. So there's also not only for logistics, also more demand from an industrial sector. Yeah, as I already mentioned, I think especially the western part of Germany is very interesting.
Thank you all for coming, and thank you to the speakers. Thanks very much, everybody.